Hello, everyone, and welcome to our webinar. Despite war and conflict, the Israeli stock market is surging this year. What comes next? We are thrilled to have you with us. Over the next hour, Brian Friedman will lead this session, followed by a Q&A. For those of you new to our webinars, allow me to introduce our speaker. Brian is president, co-founder, and portfolio manager of Israel Investment Advisors, LLC, or IIA, a U.S. Securities and Exchange Commission registered investment advisor started in 2010. As a subsidiary of GHP Investment Advisors, a registered investment advisor with $2.9 billion in AUM, he brings a solid foundation and expertise to the table. At IIA, we are the managing partner of the Israel Investment Fund LP, or IIF. This actively managed $75 million in AUM Israeli stock portfolio is laser focused on long-term growth, spearheaded by Brian. Our investment approach centers around the in-depth analysis of public companies domiciled in Israel or significantly conducting business in the region. We believe in a growth strategy that factors in both business fundamentals and the prevailing risks within the sector and market. Brian will guide us through a deeper look at how Israel's economic trajectory leading up to and since the war that began on October 7th has shaped the markets. We will explore the Israeli stock market not only as an indicator of investor sentiment, but also as a reflection of the broader economy. Israel is a country of contrasts, facing immense challenges while also achieving remarkable accomplishments. It exists in a tough neighborhood where deterrence is essential, yet it continues to foster a culture of innovation, resilience, and progress. Today, we'll examine how this balance of struggle and strength impacts both the economy and the lives of Israel's citizens. Please feel free to drop questions in the chat or Q&A box at any time, and we will address them at the end. Now, let's get started. Brian, the floor is yours.
Thank you, Amy. Before we begin, let me just set the stage. Many people, maybe many of you that are joining us today, are not very familiar with the Israeli stock market. So let me just outline a few key elements. And firstly, let me just say that the primary stock index for the Israeli market, called the Tel Aviv 125 Stock Market Index, which comprises the 125 largest companies trading on the Tel Aviv Stock Exchange, is up 40% so far this year through yesterday in dollar terms. That includes both what the underlying stock market has done in shekels, plus the substantial appreciation that the shekel has experienced so far this year. Maybe to some of you, given the headlines we read every day, this might be surprising, a 40% gain. By the time we're done over the next hour, hopefully you'll gain a greater appreciation of what has transpired not only this year, but during the course of the last 2 years of war, and frankly, the last 15 years since we started our own business, our own fund, in 2010. I will frame many issues today using that 15-year outlook, just because that's how long we've been in business. I'll look back over the last 15 years, and in some cases, project forward over 15 years. We just thought that was a useful metric given our recent 15-year anniversary. So let's just start with a moment in time. The data you're looking at is as of yesterday. The total value of the Israeli stock market is just a bit below $550 billion. That includes Israeli companies that trade on the Tel Aviv Stock Exchange, but also Israeli companies that trade in the United States, primarily technology companies. And in a minute, I'll drill down on an overview of those 184 publicly traded Israeli technology companies out of the 454 in total. Israel is a micro cap and small cap market. What does that mean? If we think about the United States, we have a almost $50 trillion market value stock market with several companies whose market values exceed $1 trillion. It's hard to fathom $1 trillion. Israel does not have a single company that exceeds $30 billion, but it does have 10 companies whose market values are higher than $10 billion. 7 of those companies are between 20 and $30 billion in market value. Just to give you a sense of scale, there are very few large cap companies in Israel. Most of the Israeli publicly traded companies are substantially smaller even than that. There are 89 companies between 1 and 10 billion US dollars in market value. There are 220 companies between $100 million and $10 billion. And then there are even smaller than that, 135 companies below $100 million in market value. Israel is a substantially smaller stock market than the United States, of course, but perhaps much larger than most people believe, at more than $500 billion. And of the 454 Israeli companies, 120 of them trade only outside of Israel, almost all of them in the United States. Most of those are technology companies. Let's put the broader capital markets into perspective. What I'm showing you on the screen right now is the value of Israeli stocks traded in Tel Aviv, Israeli stocks traded around the world, mostly in the United States, Israeli government debt, and Israeli corporate debt, all added together. The total size of Israel's capital markets exceeds $1 trillion. Now, this chart ends in 2023, the last whole year for which we have data. But given the recent stock market surge and increase in bond issuance by the Israeli government, the total value of Israel's capital markets is now pretty close to its prior peak of $1.2 trillion. When we began Israel Investment Advisors 15 years ago, Israel's capital markets had a value of $600 billion. There has been very substantial growth in financial assets in Israel over this past 15 years, much of it, but not all of it, driven by growth in the stock market. Well, trying to advance the slides here. There we go. Just by way of framing, because most people view Israel as a technological powerhouse, rightly so, I thought I'd discuss the 184 publicly traded technology companies, technology of all types, but mostly information technology, such as software, technology services, semiconductors, etc. And the way that we at Israel Investment Advisors view the world, because many people associate Israel with the moniker startup nation, which it is. Israel is a startup powerhouse. Many people forget, however, that startups eventually scale up and grow and become substantial companies if they succeed. So of the various companies that are publicly traded in Israel, technology companies, we break them into 4 major categories for analytical purposes. The first and largest in terms of revenues and profit are mature technology companies with very substantial businesses. We call that our zone. That's where we invest. There are also publicly traded startups, 71 companies that are new in their life cycle, very rapid revenue growth, but are losing money. They are burning money in the hopes to continue that growth. And then we have more mature Israeli companies, but they're sort of at the end of their life cycle. Even though they still have pretty reasonable revenues, $9 billion collectively, their businesses have weakened and they're now losing money, losing a collective $1.3 billion. Yes, there is a life cycle. Israel is a normal country. It's a technological powerhouse, but some of the startups of yesteryear that eventually succeeded fell on hard times in the later years of their life. Some of them may be ripe for a turnaround, but at the moment, their fundamentals are weak. We do not invest in weak fundamental companies. We do not invest in startups. And the final category are very rapidly growing companies that stock market investors are extremely excited about, but their valuations are high and they're losing money. At the moment, there's 7 of those high flyers. We also don't invest in those companies. We, as a firm, focus on those more mature companies whose collective revenue is more than $50 billion and who's generating profits of more than $8 billion. Just to frame both the stock market as a whole and our approach to the Israeli stock market. Once again, let's just discuss some basic principles. There are universal principles of investing that apply to all companies, all stock markets, no matter where they are. They have nothing to do with Israel versus the United States. These are important considerations no matter where or what you are investing in. And this you might call Investments 101 or the Warren Buffett School of Investment Analysis. At Israel Investment Advisors, we are trying to assess the intrinsic value of a company relative to its market value. What is the intrinsic value? For those of you that are finance nerds, you're probably familiar with this concept. It's the present value of future cash flows. You look into the future, estimate how much cash flow the company will generate, and you translate that back to the present in terms of value. That is the standard fundamental approach to investment analysis. Nothing changes when you start to apply these principles to the Israeli stock market. Professional investors often look at shorthand ratios in order to understand better what the market's perception of those future cash flows are likely to be. Of course, predicting the future is difficult, in fact, impossible. So you use these shorthand metrics such as price-to-earnings ratio or enterprise value to EBITDA, meaning the value of a company relative to its cash flow, its cash generating potential. You use these metrics to get a sense of, is the stock highly valued? Is it undervalued, overvalued, or is it fairly valued, trading close to its intrinsic value? We do the exact same analysis for stocks in the United States as we do for stocks in Israel. However, there are some characteristics of the Israeli economy and market that are unique, that in our estimation, make Israel quite an attractive place to invest in its stock market. We might look at those as 4 key elements that distinguish Israel from the United States or other stock markets. Of course, given the war over the last 2 years, but even prior to that, security is of paramount importance when assessing the riskiness of investing in Israel. Historically, investors have massively overestimated the risks associated with Israel's security. And we will argue that has been more true over the last 2 years in terms of Israel's actual security situation. But that has changed quite a bit this year, which is part of the reason the stock market has been so strong. So hold your horses for 1 minute, and we'll come back and we'll discuss security in just a second. The second we like to label Scale Up Nation. Yes, you're probably familiar with Startup Nation, as I just mentioned, but Israel is growing. Its population is growing, its economy is growing, its companies are growing, even its startups, as I mentioned before, are maturing into significant businesses. We call this phenomenon Scale Up Nation. That's what we invest in, Scale Up Nation. Post-Bahar reforms. We'll talk about this in a minute. Israel has doubled and tripled down on pro-market reform over the decades. We'll talk a little bit about what that means. What were the Bahar reforms? Why were they so critical? Why were they a turning point? And what has happened since then? Because it launched Israel on a trajectory and an evolution from monopoly in its economy towards ever greater competition. All of those elements add up to some significant and unique elements for investors in the Israeli market that I will highlight in greater depth in the coming minutes. Okay, let's talk about security. Let's talk about the war. And most particularly, I want to draw a contrast between Israel before the war versus Israel now. And I'm going to discuss what Israel looked like from a financial and economic perspective before the war. And to a certain extent, it's played itself out in terms of Israel's preparedness for this war from a financial and economic point of view. Okay. What you're looking at in front of you is a chart of Israel's military spending as a percentage of its economy, of its gross domestic product, since 1960. So let's break this into a few different periods. The first period is 1960 to about 1973. During that period of time, of course, Israel fought two major wars: the highly successful 1967 war and the victorious but less successful and more expensive 1973 war. The 1973 war in particular coincided with the collapse of Israel's socialist economy. As I mentioned, we'll talk about what I'm now labeling the post-Bahar reforms, but suffice it to say, Israel began its existence as a socialist economy, state-owned, not a capitalist economy that is privately owned. So as a result, just like most other socialist countries, that economy performed reasonably well in its early years, but it failed starting in the 1970s and had disastrous consequences for both economic growth, incomes, and inflation. And as a result, the combination of the very expensive war, the Yom Kippur War, and the collapsing economy led Israel to spend 30% of its GDP on the military. In the years following, two big reforms happened. One was a massive shift towards the market, towards free market policies, more economic stability, and a reduction as a percentage of GDP in military spending. You heard me correctly. Israel gradually, from the 1970s up until October 7th, 2023, steadily reduced its military spending as a percentage of GDP. Now, because its GDP was growing for many years, that allowed Israel to increase its defense budget, even as it decreased as a percentage of the economy. However, that changed over the last decade. Israel, in fact, did not spend enough on its defense for the last 10 years leading up to the war. If you look at the growth in defense spending over the last decade relative to inflation, defense spending grew more slowly than inflation. There was a net reduction in terms of Israel's defense expenditure, a very substantial decline as a percentage of GDP, perhaps one of the biggest and clearest indicators that Israel was not prepared for the war that they were about to fight. And as you can see, since October 7th, there's been a very significant surge in military spending. Military spending as a percent of GDP is back up to about 9%, equivalent to what Israel spent maybe 30 years ago. Another shocking detail is revealed in the size of Israel's armed forces. Once again, I'm just giving the biggest of all pictures regarding the way Israel perceived its security situation prior to October 7th, 2023. As you can see, not only did Israel reduce, in general, the total number of soldiers in its army over the last 30 years, you heard me correctly, they reduced the number of soldiers in the army over the last 30 years, believing that they could substitute technology for people. Obviously, an assumption that was proved disastrously wrong on October 7, 2023. But even more interestingly, if we look at the size of the military, the permanent military, people doing not reserves, this is the standing army, as a percentage of the labor force, it shrank from about 10% to below 4% of the labor force. Now, what's interesting about that metric, remember, is that because the Haredim, the ultra-Orthodox, participate in the labor force at a much lower percentage, this is not just because of the lack of participation by the ultra-Orthodox. This was a conscious decision to keep the army, what they believed, lean and mean, small, and technologically sophisticated. So Israel's total military strength in terms of personnel was substantially lower than it needed to be, and lower than where it was 10, 20, and 30 years ago, shockingly. As I just mentioned, Israeli defense spending was about $23 billion on the eve of the war. At the moment, Israel is spending about $47 billion to fight the war. And if you look at the growth in defense spending over the last, since 2010, as I mentioned, it grew, but it grew more slowly than the rate of inflation. It grew more slowly than the population. So the defense spending per person in Israel actually shrank a little bit, and the size of the military shrank up until 2023. And of course, overnight, everything changed. We project, we expect, and the reason I'm giving specific numbers is just to help you frame your thinking regarding what we at Israel Investment Advisors anticipate will be necessary from the society and the economy for Israel's security going forward. We believe Israel will continue spending $50 billion forever, meaning that the doubling that occurred because of the war even as the war calms down, we hope, we believe that level of military spending will be maintained. Israel needs to maintain much larger troop levels, much bigger investments in order to maintain the type of security that Israel would like to enjoy to maintain its prosperity. Defense spending per capita will rise, and we believe the overall size of the Israeli army in terms of standing army troop counts will also remain quite elevated forever. Hence, many of the debates that have already started in Israel regarding enlistment for the Orthodox, but also, I would argue, more broadly. In order to maintain a $50 billion defense budget and to maintain living standards for its population, Israel must also maintain its economic growth. Over the last 15 years, since we started Israel Investment Advisors, the Israeli economy grew 4% per year adjusted for inflation. It had one of the fastest growth rates in the developed world. We believe that growth rate in the coming 15 years will be maintained, and the Israeli government will need to enact significant reform and restructuring policies to accelerate economic growth as Israel exits the war. And we believe Israel will do so because they have done so after every round of conflict over the last 30 years. And by maintaining that growth rate, Israel will be able to also maintain a $50 billion defense budget, or even perhaps a bit more, while also growing the pie for its people. Let's discuss what that all entails and why we believe Israel has been, is, and will continue to be what we call a scale-up nation. It starts with population. Israel has the fastest population growth in the developed world. In a minute, we'll break down some numbers for you. But if I go back, let's say, to the second Intifada in the early 2000s, there were about 6.5 million Israelis. Now, there are more than 10 million Israelis. To put things in even greater perspective, when Israel fought the Yom Kippur War in 1973, there were 3 million Israelis. 3 million Israelis maintained an army roughly equal in size to what the army is today. They successfully fought off multiple enemies with hundreds of thousands of troops, aircraft, navies, artillery, tanks. To put it into perspective, even though the current war has been compared to the 1948 war and the existential threat that the nascent state of Israel faced in that war, I would argue that the war of 1973 faced much more formidable foes, certainly in terms of the scale and scope of its enemy forces, compared to the lack of scale and scope of Israel's forces. Israeli society today has the people to field a much larger army. It has the economy to field much more significant investments in its security than it did in the past. And we expect that the investments that Israel will fund will scale up in a very dramatic way for many years to come. Okay, let's bust a few myths about Israel's population growth. If we go back 15 years, once again, we're proud at Israel Investment Advisors that we just celebrated our 15th anniversary. So I'm framing everything around 15 years ago versus 15 years from now. There were 7.7 million Israelis in 2010, and as of now, there are 10.1 million. That is a population growth rate of 1.8% per year. To put that in perspective, the US population growth rate is a little bit more than 0.5% per year, and other major developed countries like Germany and Japan are actually shrinking. So Israel is quite unique in the developed world. It is both rich, with a GDP per capita well above $50,000 per person, and a rapid population growth rate. There is no other country in the world with those two attributes, and it does not appear that this will slow down anytime soon. Israel will most likely maintain the same 1.8% population growth for the next 15 years, and probably get to 13 million Israelis at that time. Now, what's interesting, it's not all Orthodox. The Jewish population in Israel grew by 1.9% per year over the last 15 years. Let's say we did not include the ultra-Orthodox in this equation just for a moment. Non-Orthodox Israelis also have the highest fertility rate in the developed world. If the Haredim are not considered, and all we did was look at non-Orthodox Israelis, all by themselves, they would still have the highest population growth of any developed country in the world, 1.5% per year. The Haredim, the ultra-Orthodox, of course, have a very rapid population growth, 3.3% per year. Over the last 15 years, they grew from 800,000 ultra-Orthodox Israelis to 1.3 million. You might surprise some of you to learn that, in fact, the ultra-Orthodox birth rate has been declining gradually. Not dramatically, but gradually. And that's partly because more and more ultra-Orthodox have been joining the workforce. Almost all ultra-Orthodox women today work, and about half of the ultra-Orthodox men. And when we did these projections, we assumed that they would continue to stay out of the army. I believe many will go into the army in the coming 15 years, and the birth rate may even slow down a bit more. Nonetheless, they will still have the most rapid growth of any segment of Israeli society, and in 15 years, they should make up 20% of Israeli Jews. So let that sink in for a minute. A lot of people have a lot of fear on this issue, unwarranted, in my humble opinion. National religious also have had rapid growth, but they participate in the labor force. They serve in the military, and as a result, their birth rate is higher than the non-Orthodox population, but lower than the Haredim that don't serve and don't work in as high numbers. And as a result, we expect that to a great extent, their growth rate will continue similar to what it's done in the past. The point being that the Jewish demographic picture is fairly healthy. And then when you compare other segments of the population, such as the Arabs, well, you might also be surprised to learn that the Arab population growth rate, the Muslim Arab population growth rate today, for the last 15 years, is about the same as non-Orthodox Israelis. Still rapid, but not more rapid than the Jewish population growth rate, and in fact, more similar to the non-Orthodox rate than the Orthodox rate. The demographic picture in Israel, certainly for the coming 15 years, remains strong. And if it turns out that social changes that bring more of the ultra-Orthodox into military service and the workforce, it will likely strengthen the picture that I'm outlining for you now. Okay, once again, just setting the scene on the eve of the war. The Israeli economy, as I had mentioned, grew from about $225 billion in sorry, I'm seeing a bit of an error. Sorry, it's about $250 billion in 2010. And now it's about 550 billion, a little more than 550 billion as of June 30th, 2025. That economic growth has allowed Israel to become one of the most fiscally conservative countries in the world. Israel had a lot of debt 25, 30 years ago. And because of the rapid growth of its economy and its discipline in terms of government budget, it allowed its debt to GDP ratio to fall to about 60% just before COVID. Then, of course, COVID required significant increases in government spending. The economy shrank a bit because of the closures. Debt spiked to about 70% of GDP. But once Israel opened its economy, it maintained its fiscal discipline. The amount of debt to GDP shrank all the way back down to about 62% of GDP. And then, of course, the war came along. And so far, Israel has had to borrow almost $70 billion since October 7th, 2023, to fight the war, despite that massive increase. Remember, I told you defense spending in total prior to October 7th, 2023 was $23 billion. So defense spending is almost triple. And the government had to borrow all of that money. Nonetheless, the debt to GDP ratio has only gone back up to its COVID era peak of about 70% of GDP. Even at this higher debt level, Israel has one of the lowest debt to GDP ratios in the developed world. The United States sits at about 100% debt to GDP. Even given 2 years of war, Israel's debt to GDP ratio is 30 percentage points below the United States, and it's 15 to 25% below almost every other developed country in Western Europe. About a year ago, we wrote an analysis that we called Israel's financial firepower. And what we wrote a year ago has proven true today. In fact, we wrote it almost 2 years ago. Time flies during this crazy period of war, where we said Israel has massive borrowing capacity, and Israel retains its massive borrowing capacity, and it has not used all of it up yet and probably will not do so. Okay. When I laid out the characteristics unique to Israel, I made mention of what I called the post-Bachar reforms. Well, one of the things I just wanted to highlight is if we go back to the pre-state era, the 1940s, the 1950s, 60s, 70s, 80s, up until the mid-1990s, Israel was a predominantly state-owned economy. In fact, it might have even been worse than many of the other socialist countries because a third of its economy was owned by the government. Another third was owned actually by the largest labor union in Israel called the Histadrut, which was sort of a quasi-governmental organization. And only 1/3 was in the private sector. Starting in the 90s and accelerating in the 2000s, Israel moved away from its socialist roots towards capitalism. And it enacted reform policies that enabled the transition of monopoly businesses that had previously been owned by the government and the Histadrut into private hands, so-called privatization. Well, that's part of the unique characteristic of Israel's economy, and I'll show you some practical implications of this in just a minute. But one of the practical implications is that Israel, to this day, retains a more monopolized economy than we are used to here in the United States. But it is shifting away from those monopolies. It's allowing companies that were at one time government monopolies, inefficient bureaucracies, to reform, to restructure, and transition themselves to become more profitable, and in recent years face more competition, but not intense competition. So as a result, they retain higher profits than their US counterparts, but a certain degree of incentive towards greater efficiency as more and more competitors enter their marketplaces. This combination of former monopoly and former monopoly profits combined with growing evolution towards competition is what creates some of the unique opportunities in Israel, and it is almost never discussed in the context of the startup nation phenomenon, which is why I'm highlighting it now. Now, on top of that broader restructuring, in 2005, Israel transformed its financial system through something called the Bahar Commission. Bahar was the Director General of the Finance Ministry at the time. And as you saw on this prior chart, there were three banks that dominated the financial system in Israel, and each of those banks was related to each of these three segments of the Israeli economy. Bank Leumi was involved with the government sector, Bank HaPoalim with the labor union Histadrut sector, and Bank Discount with the private sector. These three banks controlled almost every financial transaction you could think of in the Israeli economy up until the Bahar reforms of 2005. In 2005, the Bahar Commission did two major things. They broke up this monopolized financial system, and they put in a brand new savings and pension system with essentially mandatory savings by all Israelis. It's not exactly the same, but imagine a 401k system like we have here in the United States, except it's mandatory and let's say roughly 25% of income. What that did is at the same time that the Israeli government injected more competition into the financial system, it also injected a huge surge of savings. Israel has the highest savings rate in the developed world. Let that sink in for a minute. This is why we call it scale-up nation. Israel has the fastest population growth simultaneously with the highest savings rate. The amount of capital piling up is very rapid, and that savings rate is substantially higher than the United States and frankly any other developed country. And that all goes back to the Bahar Commission reforms starting in 2005. Another unique characteristic of the Israeli economy and financial system, which is why today, instead of just three banks dominating every financial transaction in Israel, today you are looking at a much more diversified financial landscape. You have multiple players in banking, insurance, asset management, credit cards, lending. However, it is not the United States. In the United States, we have 7,000 banks, tens of thousands of asset managers. No, in Israel, you have a handful in each of these sectors. That's what I call managed competition. Israel's economy was moving away from dominance, monopoly dominance, in this case, each of these three banks in a segment of its economy, but it's not moving to thousands of competitors, it's moving towards dozens of competitors. Granted, it's a smaller market. Nonetheless, that managed competition has allowed the Israeli financial players to both have higher profits, higher returns on capital, combined with increasing intensified pressure towards efficiency. There is a slow evolution towards more competition, away from monopoly, but you still have a little bit of excess monopoly profit with more and more pressure towards efficiency. That is a unique combination in the world that, from an investor point of view, is not often emphasized and has led to our returns and many of the market returns in the Israeli market. Let me put some meat on the bones for the efficiency story, and I chose just one of the banks, legacy banks, Bank Hapoalim that I just mentioned, to give you a sense in a more concrete way what I am talking about. When Israel began to privatize its economy and it began to privatize its banks, the banks had very large workforces that were entirely unionized. The profits were low, the return on capital was low. Then they privatized the banks, and the new private sector owners began the transition towards greater efficiency, reducing the workforce, creating more flexibility in the workforce, and improving the economics of the business. So Bank Hapoalim today, if we look at the growth in its total assets per employee, you can see the dramatic increase in productivity. This story continues because during this 15-year period of time, there has been more competition for the lending business, more competition in the credit business, more competition from asset management. And as a result, even though there are still just a handful of banks in Israel, there is pressure, not intense pressure, but growing pressure on improving productivity and profitability. And this shows it, I think, in about as concrete a way as you can get. Fewer employees doing more things, more assets on the books per employee, therefore higher and higher profits. It's maybe not as dramatic and exciting of a story as you get with whiz-bang technologies in a startup, but you can hang your hat on these numbers to a greater extent and bank on them, pun intended, to a greater extent. And as a result, you get the combination of improving economics at much lower risk than in the startup nation universe. That's why we invest in what we like to call scale-up nation. Okay, we're coming close to the end of my presentation and we'll open it up for questions. But what I wanted to highlight here is tying the dots together. I mentioned at the outset that the Israeli market is up about 40% so far this year. It is reached new highs. And one of the things that I think people are surprised, given the headlines related to Israel, that seem dark and in some cases dire. How is it that the Israeli market can be performing so well? How is it that our fund can be performing so well? So what I did is I took one of those shorthand valuation metrics that I mentioned in the beginning, the enterprise value to EBITDA. That is a very good indicator of value in the stock market, particularly when you're comparing companies across countries. Enterprise value is the value of its stock. So the total value of a company in the stock market plus the value of its debt. So if you think about a company in terms of a pie, the pie has two halves. It has its equity and its debt. If you add those two together, you get the total value of that pie. That's enterprise value. And EBITDA, earnings before interest, taxes, depreciation, and amortization, tells you the amount of cash available each year that goes to each of those equity and debt slices of that pie. It's a good indicator of the overall value of a company. So in this case, we applied it to all of the companies on the Tel Aviv 125 index versus the S&P 500 index in the US. The first thing you should notice is that Israel always trades at a lower valuation than the United States. Well, this makes sense for two reasons. One, the security considerations that I mentioned at the outset. Israel does face security threats. The question is, how big are those threats, and are investors over or underestimating those threats when they're pricing Israeli securities? But also because Israel, as I mentioned at the outset, is predominantly a smaller company market. And even in the United States, smaller companies tend to sell at lower valuations than larger companies. So when we look at those factors, we see that for many years, the Israeli market sold somewhere in the neighborhood of 70 to 80%, maybe in more optimistic times as high as 90% of the valuation level of the S&P 500. Starting with the COVID economic shutdowns, the rising interest rates, judicial reform debate in Israel, and then the war, you will notice that the valuation discount that Israel began to receive widened in a very big way because of all those factors. So far this year, and including last year when the Israeli market performed remarkably well, we have seen a snapback in that gap between Israeli valuations and US valuations back to its more historic norms of 10, 11 years ago. So even though the Israeli market is up 40% so far this year, all that's happened with that dramatic rise is a return to the analysis of 10 years ago, meaning investors perceive that there is still risk in Israel from a security point of view, but that risk is substantially less now than it was a year ago, 2 years ago. And those perceptions of risk, in my opinion, have room to shrink further, given the dramatic military success that Israel has achieved against its most formidable enemies, Hezbollah in Lebanon, even the Assad regime, which is now gone in Syria, and most particularly Iran. I think investors are interpreting those recent military successes as durable, and that they are now valuing Israel as if it was returning back to its status quo ante in terms of security in the mid-2000s, 2010s. I believe Israel's security may even be better, but I doubt perceptions will close further until we see some resolution in Gaza and the broader war. Finally, let me just mention our own fund. Over the last year, we're up 93%. Yes, you heard that correctly. Over the last 3 years, 19% per year, 19.8% per year over the last 5 years, and 11.7% per year since inception. We have done that with less risk. That's what this beta says down here at the bottom. We're proud of those numbers. Hopefully, through the course of this presentation, you've learned some of the backdrop to how we've achieved those returns. And I know I've gone a little bit over. I look forward to your questions, and let me open it up for questions now.
Okay, Brian, I'm going to read the first question. In light of the rising stock market in Israel, even during the ongoing war, how should we understand Prime Minister Netanyahu's recent reference to Israel becoming a super Sparta and potentially moving toward an autarkic economy? To what extent could this vision, combined with current worldwide public opinion about Israel's shape, or disrupt the positive market trends we've been seeing?
Yeah, that's a good question. I don't know how many of you saw Prime Minister Netanyahu's speech yesterday. I would say that I disagree with his perspective. It would be a big problem if Israel were to try to become an isolated, autarkic economy. 50% of GDP is exports, most of which are technology exports. If you look at the onslaught in terms of threatened sanctions and trade restrictions, the good news is many of those would probably not touch these technological exports. We don't need, that's a whole other webinar. So I think that the bark is much worse than the bite. I think he was most focused on Israel's military imports and military exports. Even then, I believe he is correct. Domestic military industries need substantial investment, and they need to fill in many of the gaps and risks that Israel faces in terms of military supply. However, even there, Israel cannot go it alone. So I'm not sure what his point was there, but on its face, I would say he's wrong. So I hope that's not the vision of the future for the state of Israel.
Thank you, Brian. This one is a little bit, it's connected because, most people have in mind what's happening now with the war, but this one has to do with the news. The Israel we often hear about in the news can look very different from the Israel you describe through your investment perspective. What advice do you have for investors on navigating media narratives and distinguishing real economic signals from the noise?
Oh, wow. That is a big question. There's mostly noise. Israel, the signal is very difficult to discern. The way I frame this, and this is how I talk to Israelis, because many of the Israelis I talk to can't believe how well the financial markets are doing, given how pessimistic they personally feel. And you have to remember that in Israel, when we talk about security, who provides that security? It's your own children. It's your brother. It's your cousin. It's your neighbor. That's who provides the security. So it's not fully sufficient to say that the Israeli military can maintain security for the Israeli economy to grow. Because when Israelis hear that, they say, well, that may be the case that we will have future security, but what if it comes at the price of continuous engagement by my own children? So that is where I think you get some of the disconnect in Israel. And they're 100% right. But when I come and look at this dispassionately as an investor, I say, yes, but the security will be provided. Israel is in a much more secure position than it is today, and there will be room for the economy to grow. And part of the reason that that will happen is because there will be more people in the society involved in Israel's security in the future than there were in the past.
Thank you, Brian. If you don't mind advancing to the last slide, because I do want to mention we want to be respectful of your time, so we can't answer all the questions. But if you want to reach out individually and ask the questions, we're here. I'm putting there my phone number, my email, and our website. I want to thank you for joining us today. The recording will be made available very soon, and we encourage you to help amplify Israel's economic story by sharing it with others. As we close, we also want to express our heartfelt prayers for the safe release of the hostages, for the protection of the people of Israel, and for the peace in the region. Wishing you all a good and sweet new year. Shana Tova Umetuka. Thank
Shana
you.
Tova. Thank you for joining.